Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hello, and welcome back to the Get Real Podcast. This is your host, Heather Marchant. Ron is not with us today. Just has a crazy week in front of him. So I have an awesome guest we're going to be talking to today. And so I thought, man, Ron, you can take your week to catch up. So it works out sometimes for all of us to have that time to catch up. So with summer coming, I think that may be a little more common for Ron and I this summer to make this work with our family's plans. So we have a lot of good content we have coming up on the podcast. Super excited about so many things that we're going to be covering with the market shifting and changing. Feels like shifting and changing every day. It makes it fun and exciting to be able to keep you guys up to speed and understanding what's happening. So I am joined today by a lender and a client. His name is Brendan Kolesar, and he was referred to me by a lender that Ron and I worked with. I'd have to pull out a calendar, but probably 8 years ago or something like that, a long time ago, out of Southern California. Jason Gill, for those of you listening that have been around for a little while, referred Brendan to me to buy properties. And he's been a great client and bought several properties. And then he was referring some friends. So Brendan, first, I'll welcome you to the show and then talk a little bit more about how we met. So welcome to the show.
Well, thank you so much for having me. Appreciate it. And yeah, Jason and I go way back. So when I saw that he had been buying a few properties, I asked him, what's the scoop? Because everyone's dream is to be able to figure out how to find a property, who's going to manage it, all the things that you guys wrap up into a bow. And I just love your business model. So it's been awesome, not only as a client, but then meeting your clients as well. So thanks for having me.
Well, thank you. The feeling's mutual. So it was a fun relationship because you referred a couple of friends that were clients. And I said, well, hey, you were referred by Brendan. Can Brendan do the loan? Which I didn't think you could. I thought you were just a California lender, right? So I always give that courtesy, especially, the client that referred business to me, that I refer business back. So I said, why don't you handle the loans, Brendan? And I was blown away from that point. And I kept it to myself for probably a couple months that you blew me away. But the organization was on point. I mean, detailed, specific. I knew what was happening on the transaction. Your team was reaching out for information that I knew you guys knew what you were doing.
Yeah. No, we thank you for that. I mean, that's music to my ears. I mean, it's been a long work in progress. I've been in the business for about 20 years, and I've been working with the same team now for the better part of a decade, and just creating a great client experience. I actually have a saying on my wall in here that says "protect the experience." It's one of my a saying my business coach actually kind of coined with me, and that's kind of what we focus on. Making sure that everyone understands where we're at. I always tell the team, if someone has to ask questions, then we're not doing our job, right? So just being as transparent as we can, just so that everyone can enjoy the process versus, stressing about it. So,
wow, I didn't know that. That definitely shows because one other thing too, is when your clients were referred to me, they were the ones to remind me no. If I forgot, it was no, I want to work with Brendan. Right. So your loyalty that they have to you was also something that caught me off guard. That doesn't really happen with mortgage lenders very often.
Yeah. I mean, whenever I meet somebody new, I always kind of reiterate to them how we structure our business model. I try and run really lean margins, because the last thing I want to do is do a transaction for somebody to find out that they ran off and refied with somebody else. Once you work with us, I want to help you forever, if that's possible, or for the next 3, 4, or 5 purchases or whatever you need. I want to be the person that they think of first. So yeah, it's it's the return business and repeat business is huge for me. And when I find out someone went somewhere else, I always try and figure out why. So that's a big thing.
Great business advice too. We have a lot of business owners that listen, protecting the experience. That's a really cool takeaway, and making sure that, your whole team is obviously on board with that, because I can tell and I feel that in communicating with your team. So I think that's really powerful for any business in any industry. So
Absolutely.
referrals are amazing.
100%.
So I fast forward, maybe I got to think, maybe almost 6 months, maybe, that I had kind of just had my eye watching and paying attention to your process, because we've worked with a lot of lenders over the years, and we aren't quick to jump ship. And we are one of our core values is loyalty, right? So we're looking and seeing, okay, how can we help our clients where we have a couple of holes in locations and different types of offerings and different types of mortgages. And so I didn't move very quickly, but eventually I came to you and said, hey, so I'm noticing that you can handle, number one, you understand investment loans, you're an investor yourself, and that your clients love you. And I've seen the organization, and I said, are you open to taking on some business from us aside from your friends?
Right.
So that started a conversation that has really, I think, been mutually beneficial for several months now, sending a lot of clients your way, and have had fantastic feedback from the clients we've sent your way. So thank you for that.
Yeah, so happy to hear that. Thank you.
Yeah. Well, your depth of knowledge is impressive. It helps that you understand it because you invest yourself. I know you are obviously you're a mortgage broker or mortgage. Are you a broker?
We're a bank.
Bank. Okay.
I work for a mortgage bank based out of Colorado. Licensed in most states. My team specifically is licensed in 18 states now. So, but we can cover the rest through like an internal program we have. So, there's not a state I don't think we can do in one way or another. But we do broker certain products, that we'll kind of get into and probably touch on here, because not every bank is going to offer everything. So there's non-QM products out there. There's jumbo investors, but we're approved with a big gamut and list of wholesalers that we work with regularly as well.
Okay. So let's jump into that a little bit. I'd like to understand though, for everyone, tell us a little bit about your background and how you got into the industry, what you like about it. I don't know. I'd just be curious.
Yeah. So when I got into the industry, I was, 22, and I was actually working with Jason Gill at 24 Hour Fitness. He was selling memberships. Yeah. We were just kids, cutting our teeth in sales. And
I love that.
And obviously the market at that point was crazy. All these crazy products were available. And, so I think someone dangled a carrot, and that was really kind of what pulled me into the business at that standpoint. I've always had a knack for, talking to people and being able to confidently sell something that I understood. But I would say it was really in 2011, I moved to San Diego to take a job with a mortgage bank. I was in the broker space prior to that, a kid in my 20s. Making money, doing the job, but maybe not really running a business. So in 2011, a dear friend of mine invited me to San Diego. He needed someone he could trust. His business was growing, and it was all purchase business, doing a lot of investor flips, and just, the market really, had changed at that point after the meltdown. So, took a job at that point in San Diego. Really, I could say that he was the first person that really taught me how to run a business and turn this into, a relationship with agents and all the other types of lead sources, and kind of focusing that on like being your business, and the results of that were the opportunities and then the clients that they referred you. So, since 2011, I worked with him for a couple of years, and then broke off into my own team. And we worked pretty much in parallel in the same banks and whatnot. And, that's how I developed and grew the team I have now. And, since 2014, we've been recognized, in the top 1% nationally as one of the, best lending teams in the country.
Wow.
So it's something I'm pretty proud of. And,
That's awesome.
We just try and keep that process flowing. I mean, that's what it really, really boils down to.
Yeah, no, that's fantastic. I love that. So I think it's exciting that you offer conventional loan products, right? What our clients are mostly used to. You're 20% down. The typical, you have competitive interest rates that I've seen as well. Talk to us a little bit about the rates rising and what you've done, or how, because I've had client feedback after they talk to you, they're a lot calmer about rates rising. They're not in the panic.
Right.
So talk a little bit about how interest rates rising and how it's impacted your business.
Yeah, it's interesting. Pre-COVID, I was doing a lot of seller buy downs. The market was just different, and it was something that wasn't really prevalent. And obviously during COVID, which my personal opinion is that was an asterisk, I mean, those 2 years were just unprecedented, as far as like market and everything and rates dipping. So, as they've started to, run away from us the beginning of this year and to today, we just started revisiting a lot of those older habits and looking at the buy down options and just talking people through, what that looks like from an investment standpoint, because as rates have risen, if people want to throw money at down payments, so then we show them the correlation between a down payment and a rate buy down, and usually their jaws drop because the cost versus the benefit is it speaks for itself. It's usually threefold, so just kind of revisiting some of those old habits, when rates were higher, pre-pandemic, and just figuring out ways to back people into a scenario that's comfortable for them, talking about tax benefit, just, a lot of those conversations you have to have for people to be able to make the commitment, rather than just saying, oh man, I can do this at 2.5%, it's a no brainer. So just educating your clients.
When we have a seller incentive, right? A lot of times we'll negotiate a seller incentive, and sometimes we'll actually, in my own purchases, I bump up the price and add a seller incentive, right?
100%.
If I'm not scared about an appraisal, and if it doesn't appraise, I just drop the incentive. So it's no risk, right? In that regard. So we have that credit more and more often for the same reason you said, right? This isn't our first rodeo, and we know that that's a great way. But is there a cap on how much you can buy it down?
So when you're talking about Fannie Mae loans, there are certain factors you have to take into consideration. You have to look at your HPML test, which is a high price mortgage loan test that's ran by your compliance team. But if you earmark the credits specifically as being used for discount fees, that increases the cap substantially, because you can remove that credit from that HPML calculation.
That's
one
you
of the little tricks of the trade. Yeah. So it's all determined by how you word it, making sure that the bank understands that if you word it that way, you can remove it from that calculation. Obviously, there are caps on the amount of credit you can get from the seller. So especially on an investment loan, we know it's 3%. So, going beyond that, though, is what a lot of your guys' clients and other clients of mine are actually doing. They're taking the credit, buying down, and then, even going deeper and paying on their own rather than putting down another 5%. They're paying, 1 or 2% in addition, and it's cheaper and the benefits greater.
Yeah, that's awesome. Yeah. Really good. Because we talked about 2 weeks ago, we talked about that eventually and soon, probably, we're going to see that the cap rate is going to be higher than the cash on cash return, potentially, with traditional conventional mortgage rates. But if you're, being creative and finding a way, instead of putting out all that cash, that you can be creative with someone like you that can give some guidance and some expertise to say, why don't we do this instead? And you can bring up your cash on cash return, not worth paying all your cash out for a cash purchase.
Right.
Okay.
Yeah, 100%. Cool. I mean, it's interesting. I would say 10 times out of 10, when we've showed people putting down 25% versus 20% with an additional buy down, that's the way they've gone. And for the exact reason you're talking about, is keeping that capital to be able to potentially, look at an additional property instead of putting extra in one specific property. So.
Yeah, exactly. Very good. Very good. And then I know we've talked recently about some other loan products that you have access to, if clients maybe have other needs or maybe can't qualify as easily for whatever reason. And as the market shifts, potentially they could make it harder to qualify for a conventional mortgage. So what are some other options clients have?
So a big one recently, and I know a lot of our non-QM investors are pushing specials to try and increase their portfolios of this product, is it's called a DSCR, or a debt service coverage ratio. So effectively, we don't even look at income. We just structure it based off of a 0.85 income factor when you take the payment and divide it into the rents. And if it's below 0.85, you can qualify. Obviously, there are LTV and credit score adjustments. So, the rates are going to move based on those, but you can do that with 20% down. And again, you can buy down the rate. There's also an interest only option that turns it into a 40-year loan. The first 10 years are interest only. And then at year 10, it turns into a 30-year fully amortized loan, which obviously is going to increase the payment. But, the goal by then is to either have, flip that property into a different loan, or just be ready for that. And maybe the rents have increased enough over that 10-year period where that fully amortized payment, would still cash flow. Or what a lot of people might do in that situation is make an annual payment and recast the loan and actually put money towards the principal, even though your monthly payment is only interest only. So lots of different ways to combat that adjustment timeline, but it gives you flexibility.
What are the disadvantages of doing something like those types of loans instead of conventional? Because it sounds really dreamy.
Yeah, no, I mean, the interest rates are a little bit higher. That's been, the primary pushback that people have had.
How much higher? Typically?
Just to give you an example, I ran some pricing for a client with 40% down. Their Fannie Mae rate would have been 5 1/8, and this product put them at 6 1/8. Okay. So it's 1%, but depending on the loan amount, I mean, your interest is still tax deductible. So, it's not going to be a huge difference. I think on $100,000, it was like $70 a month on that rate difference. But it's for folks that would otherwise wouldn't qualify anyway.
True.
So,
good point.
It's just, finding a way.
Is there a prepayment penalty on a?
Yeah, so we're going to go next. There is a 3-year prepayment penalty. It's going to vary per investor, but a standard would be 6 months of interest is what you're looking at. Okay. And you can actually buy down the prepay. If I remember correctly,
interesting.
I think you pay like 3/8 to remove a year. I'd have to go back and double verify for you. I don't want to misquote.
But you could pay to
nominal.
Get it off, I guess.
Yeah, yeah. You can reduce it.
So for clients that have never, because most of our clients are dealing with conventional loans,
right?
They may not be familiar. So talk to us. What is the prepayment penalty for? What does it look like?
So it's 6 months of interest is kind of the standard, would be what you would pay if you were to pay off the loan via sale or refinancing within that window. Most of these loans are portfolio loans for big hedge funds and private type banks. They're called non-QM lenders, which is a non-qualified mortgage. All your Fannie Mae, Freddie Mac loans are QM loans or qualified mortgages. The big thing for them is just retention, right? Yeah. So they don't want to see a bunch of their loans, disappear off the books, within a year, because, they've paid out everyone that's worked on it. They've paid us for providing the loan. They've probably paid some sort of service release premium to whoever's servicing the loan for them. So there's just cost associated. And so in order to remove it, that's why they want you to pay to remove it or reduce it. So it's just a hedge for them to kind of protect themselves.
Yeah, because that was when I first started working more in the commercial loan space, helping clients buy larger properties. I was like, wait, what? You have to, I mean, that was years ago,
What's
but
a
you have to,
prepay?
yeah, I'm like, you have to pay if you refinance or sell your property. Like what? So that
Oh
was
man.
something new to me. So I wanted to make sure everyone was on the same page.
I remember getting into the business. People were buying loans that were fixed for 2 years, amortized over 30, and they would come with 3-year prepays. I mean, it
Oh,
was just,
wow.
so you'd have to wait a whole year of your adjustable period before you could refi. I mean, it was, yeah,
Wow. Oh,
there
yeah,
was
that is
there was
tricky.
some crazy stuff going on back in the early
Yeah.
2000s for sure. I mean, I'm so glad. I mean, today it's just, you qualify or you look at something like we're talking about now, and makes it a lot easier and more ethical for sure. I mean, the
Yeah.
business is great now, in my opinion.
That's awesome.
Yeah.
So, as far as those non-QM loans, do you
Mhm.
have to pay points up front as well?
We structure them with points, and reason
Yeah.
being is that if you don't, then it's going to affect the interest rate.
Okay.
So we're structuring them with 1.5 points. Depending on, yeah, there really is no, I mean, depending on the investor, I would say, but I think we have one investor we can pay 1 point, but their rates are already a half point higher to start with.
Got
So
it.
it doesn't really make sense. Yeah. And I mean, so I look at it like, hey, if we're getting some money from the seller and we use that to cover, the cost for us, plus we have some money left to be able to buy the rate down a little bit, we can still make a pretty attractive proposal with these products.
Yeah, no, that's awesome. And I
Yeah.
like that you have different options at your disposal, right? So if we send someone your way or someone reaches out to you, then
Mhm.
you can say, "Hey, well, if you don't fit into this box, then how about this box?" Or I think that's really helpful to have those
Totally.
options. And
Totally.
that you can work in multiple states. So, talk to us. I'm going to put you on the spot and talk to us a little bit about what you think is going to happen with rates, because I know you shared with me a little bit about your thoughts, and
I mean,
it's going to be just your thoughts. I'm not
okay.
holding you
I
to
mean,
it.
I think the first 5 months of the year, I mean, we were in such a free fall from the performance of mortgage-backed securities that most investors and banks were just kind of ducking for cover, right? They're like, what
Mm,
do we do? How far is this going to go? And if I were to, give you my thoughts just based on me looking at, the performance of mortgage-backed securities, we've been pretty range bound since April 18th now, which means
mm,
that's when the free fall stopped as far as the performance of mortgage-backed securities. So now we've got kind of like a head and shoulders pattern going now, and we've got a range. So this is where I feel like investors get comfortable.
mm.
And so we're going to see rates kind of level off a little. And, we might see some breadcrumbs as far as them actually improving. I'm not going to say drastically. I mean, we're still going to be at a start rate in the sixes on your Fannie Mae, investment
Yeah,
properties, and in the fives on your primary residences. But it is just nice to take a deep breath and let them kind of figure things out,
yeah,
because up until that point, I mean, everyone was just crawling under their desks every day because they didn't know what to do about rates and how far to hedge for that day. I mean, it was pretty unprecedented. So
hmm,
um I think long term we're going to see them probably continue to slowly increase. I just don't think we're going to see the crazy movement that we saw the first part of this year.
That's
And that's
really
a
interesting.
conversation I have with people too, who are like, oh, I'm going to wait for the big R word to kick in to see, where rates go. My point to them has been, yeah, if we get an improvement because we go into a recession, what's the starting point?
Yeah,
Today, if we're at 6 and we went into a recession, maybe we dip back down to 5%, 4.5, God willing. But what if we're at 7.5 when that point finally starts, and now we're coming
yeah,
back down to 6?
yeah,
So, get in and then figure it out and see if you can do better down the road. Come up with a game plan to potentially get a credit, to buy down the rate. I mean, to make it work from a cash flow perspective. Now, I don't think there's really a lot of upside in waiting, in my opinion. I mean,
yeah.
the inventory levels are still, historically low. So there's, you still see feverish activity around properties that are priced appropriately and, presented well by you guys, with the cash flow perspective. And so I don't know. We'll see what happens.
Yeah, I mean, it feels like every day is a new day with
Right.
figuring out what's happening. We reach out to you and your team, gosh, at least once a week, and
Right.
say, what's the latest?
Right.
What's happening? And because it's good to be updated and aware and educated, but at the same time, the properties are cash flowing now. So even if the market dips and we have reduction in the amount of equity you have in your properties, you still have a cash flowing asset, right? So
Totally.
we've talked about that on here a lot, that if you stick to your principles and you don't go outside of your principles to stay in the game right now,
Yep.
which is really tempting to do sometimes. I work with the acquisitions team a lot in vetting properties, and man, to say no to properties right now when we have such a strong demand and clients
That's
feeling
gotta
like,
be tough.
yeah, it's hard because you're
Yeah, I
like,
bet.
well, it doesn't stick to our principles, but so it's sticking to your principles, that it cash flows, that you're buying smart, that you're not speculating on rents. We're going to be talking about that probably next week, looking at how a lot of hedge funds and stuff have been speculating on rent increases. And yeah, that's just not going to work, right? So buying smart, and having someone like you, Brendan, that can help walk them through different options, so that they feel comfortable buying, with the interest rates they have. So I think that's awesome. How do people get a hold of you if they are wanting to reach out? What's the best way?
You know what? My email address or my cell phone number. I mean, I'm happy to drop a phone number if that's appropriate.
Yeah, go ahead.
So my cell phone's 916-541-1808. I've got a great team. So, once you either call or text me, I'm going to either pass you off to engage them, or, we'll have a conversation and then get the ball rolling on, figuring out a game plan.
Yeah, I love that. And we'll, I'm sure, be sending more business your way as well. But we have some people that listen in that are buying elsewhere, or not all just clients. So cool. Thank you for joining us today. Absolutely. Thanks for your time.
This was fun. Thank you.
Yeah, we'll probably do it again. I mean, this changes all the time. So
yeah, happy to.
All right. Thanks, you guys. And make sure, if you have any suggestions for future shows, please reach out at invest@rpcinvest.com. And we would love to have your perspective and ideas. I just received a couple this last week that I'm already working on lining out some episodes for. So thank you for that. Keep those coming. And please leave us a review on the podcast. A written review actually allows more people to be able to see our podcast when they are on Apple or whatever device they're looking at. But it makes it more visible for others, the more written reviews you have specifically versus just the star ratings. So please do that. And a lot of takeaways from our call today with Brendan. Super excited about the year that's left. We have 6 months left. We are halfway through 2022. So
crazy.
Yes. Get out there and make something happen, so you're not finding yourself in December, like so many people I talk to, saying, I wish I would have. So make something happen this week, you guys. Have a great week.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.